Debits and credits explained. Assets are things that you own, like heavy equipment, cash, and real estate. Liabilities are things that you owe, bonds owed to creditors, and potential damages from a lawsuit. Stockholders' equity is who owns the company. It's also called owner's equity or capital. Assets equals liabilities plus owner's equity. This is called the accounting equation. What the company has belongs either to the creditors who hold the liabilities or the stockholders who own stock. Revenues are inflows from customers. Expenses are the costs of bringing in those revenues. There are different things the company has to pay for in order to make sales and profit. Sometimes they're a little too high. Revenues minus expenses equals net income. Net income is what most business people are looking for. Now, net income belongs to the owners. Assets equals liabilities plus owner's equity. Net income belongs to the owners. Therefore, net income will flow to the owners. This could be shown a different way. Revenues go to the owners. Expenses come out of the owner's share of the company. We could rearrange all of this like so. Assets on one side, liabilities and owner's equity on the other, where revenues flow into owner's equity and expenses come out of owner's equity. If I want to express this without a subtraction, I can simply move expenses to the left side, so that assets and expenses equal liabilities, owner's equity, including revenues. This is debits and credits. Debit accounts are assets and expenses. Credit accounts are liabilities, owner's equity, and revenues. It's extremely important to understand which accounts are debits and which accounts are credits because they're treated in opposite ways on the books of the company. A debit account such as cash is going to be debited. The number will be written in the left column in order to increase it. To decrease it, it will be credited. The number is written in the right column, the credit column. On the other hand, credits, such as bonds payable or liability, to increase them, you will credit them, write the number in the right column. To decrease them, you will debit them, write the number in the left column. If you accidentally debit a credit account or credit a debit account, the amount will go in the wrong direction. Check out my website at accountinator.com. It's do-it-yourself accounting, quick, cheap, and easy.
Defining the concepts. Assets are referred to as things the business owns, for example, your vehicle and your equipment. Liabilities are people or businesses that we owe money to, for example, your loan shark and creditors. Equity is referred to as the owner's interest in the business, for example, your investments and your drawings. Drawings are things or money that the owner takes for personal use.
Yo, you wanna be an accountant? Think it over, it ain't easy, you might need a folded clover. If you ain't willing to work hard, then can it. It's the most sought after job on this planet. Now, you tell me you wanna be an impartial judge of my solvency. Now, you tell me you wanna protect the world from corporate fraudulency. Now, all that sounds like fun, son, but you gotta walk before you can run. To know what these numbers mean, you gotta know the debit credit theory.
Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Balance all of your transactions.
So, Wanna know budget, cash flow, where your money go? Then give in to the temptation. Understand the fundamental accounting equation. An asset increasing is a debit. An asset decreasing is a credit. The reverse is true for liabilities and equity. If you get this, then you get accountancy.
Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions.
On a high road, I gotta work your way up to controller. You ain't born a high road, I gotta work your way up to controller. You ain't born a high road, I gotta work your way up to controller. You ain't born a high road, I gotta work your way up to controller.
Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Debits on the left, credits on the right. Debit left, credit right, debit left, credit right. For complete satisfaction, balance all of your transactions. Debits on the left, credits on the right. Debit left, credit right, debit left, credit right.
I hope this video is really going to help you with studying the 5 elements of accounting. So, as you can see on your right hand side, it's a debit. So everything that's on the debit side has a balance or increases on the debit side. And on your left hand side, you have a credit, which means that everything that falls under your credit side has a balance or increases on the credit side. Alright, so as you can see this hand, we have a small finger, which represents the least things that you want to worry about in your business, which are your expenses. You don't want to operate a business with a lot of expenses, right? So this small finger represents your expenses. It's the least things that you want. Then the ring finger, once you get married, you get a ring, and that ring is yours. It belongs to you. So what are the things that you own, or what are the things that the business own? Those things are called assets, right? And then this finger, the thumb, or what you call it, yes, this thumb finger represents you are okay, you are sharp with having this in your business. For your business to operate, you need income, right? So once you have income for your business to operate, you are okay, you are sharp with this finger, right? And then this one, when you owe people, people will come at you or come to you and actually point at you and say, yay, you need to pay me my money, right? So for you to avoid people pointing at you, you need to make sure that you always pay your liabilities. So this finger represents your liabilities. That means your people that you owe. So the last finger, which is the middle finger, represents your owner's equity, which is the investment that owners make into the business. I hope this really helped you guys. Thank you.